So there's a term that I use a lot whenever I'm teaching and doing these webinars, and the term is context. I have the definition of context up here, and I'm not bringing this up to, act like I'm talking to a first grader or to talk down in any way. It's to make a point. So context, the definition is the circumstances that form the setting for an event, statement, or idea, and in terms of which it can be fully understood or assessed, or fully understood and assessed. The example is the decision was taken within the context of planned cuts in spending. So if you were viewing this from a trading perspective, what you would change this around to say would be something to the effect of the decision to make the trade was taken within the context of it was early in the day, we had a news release that was moving the market. The market was approaching prices that acted as support yesterday, and therefore, since it was busy and there was a lot of order flow and we had the news event, I made the decision to go short, thinking that large players would try to run yesterday's support level, or something to that effect. Basically all about context, as opposed to alternatively to that might be right now it's 2:30 p.m., nothing's happening. The market has been in a 3-tick range for the last hour, and even though we're approaching yesterday's support level, or even though we've been sitting at yesterday's support level now for the last 20 minutes, there's no reason to think they're going to run support or even bounce the market higher because nothing's happening. Nobody's here, right? So it's always about context, and I think this is one of the hardest things for newer traders to get a grasp on. So when a new trader starts out, there are some hurdles to overcome. And this is a list. There are obviously a lot of hurdles. It depends on a person's particular situation in terms of how much money they have. Can they sit in front of the screen every day? Do they have a job? Do they have a family, etc.? Obviously, all that stuff is very personal. But some of the things that are common to everybody would be these particular hurdles right here. So the first hurdle for most people is just understanding the game at its core level. So understanding what is happening exactly. Why am I seeing what I'm seeing? The next would be identifying price action that repeats. So that's when you're starting to look for price action that might tip you off to the future movement, obviously. And that's what the majority of instruction is based upon. But all this works together. You have to understand all of it to be consistent with your results. The next hurdle would be once you do think you start to see price action that repeats, you have the discipline to stay out when there's no good trade, as well as having the ability to instantly fire when there is a good trade. So a lot of people, they're always talking about having the discipline to adhere to your risk stops or stay out and sit in your hands, which is very, very important. I agree. But you also have to have that other side to you that allows you to instantly click your mouse and place the trade when you see something that you've seen before. So the next hurdle would be once you execute the trade, you have to learn how to manage it properly. And then I think, like I said, that probably one of the biggest hurdles to overcome is understanding the context of the situation. And that's what I'm going to touch on here in this video. The first few starter videos that I have all talk about these hurdles here, pretty much, these 4 hurdles right here. And I do mention context throughout all of my material, but I still receive enough questions about trying to understand when a step in the profile matters or when the level is likely to hold, that I felt this deserved its own video in the starter series. So what I'm going to do is kind of walk you through a few of the ideas and then move along to showing you real-world examples of how you apply this. Okay, so what we're looking at right here is just a picture of an electronic poker table. And the reason I want to show you this illustration is because it helps me with an analogy. You don't have to play poker to get this. Trust me, you'll get it as I go through it. But basically, when you're trading, obviously, in order for you to make money as a trader, if you, I'll bring up an illustration here. If you buy 2.5, somebody else has to be willing to buy 3s in order for you to make money. Conversely, if you sell 2.5, somebody else has to be willing to sell 2s in order for you to make money. So whatever price you get in at, someone has to push it for you to make money, right? So that means there have to be other players in the game, other guys who want to play, get involved. So the way that I compare this to poker is as so. Let's say you have a poker table and you've got 10 seats around the table. And all 10 seats fill up. So in seat 1 and 2, you have two very, very good poker players. And 3, 4, and 5, you have guys that aren't fantastic, but they're better than average. And then in 6, 7, 8, 9, and 10, you have guys that don't play very well at all. And they're mainly just there to have fun. They're not interested in learning how to play better, whatever. You know, they're part of the game because they want to gamble. So when that game starts off right from the get-go, everybody buys in, everybody has just sat down, everybody is ready to play the game. So what that typically means is that guys are going to be betting all over the place, trying to make moves, trying to win money, trying to take down pots. Even if a guy goes broke, he loses, he'll just buy back in and, you know, try it again and continue on. In terms of trading, when the market just opens at 8:20 a.m. in the case of the treasuries, or 9:30 when stocks open, or whatever market you may be trading, respectively, quite frequently, guys are ready to go. You know, they sit down, they're ready to play the game, they're ready to fire. And so that is conducive to movement, obviously. And again, if this sounds obvious to you, that's fine. You may already get this, but there will probably be some examples later in this video that'll help you out in terms of identifying certain types of movement and when you do and do not want to be in a trade. So let's say as this game progresses, basically, you know, this guy busts out, this guy busts out, this guy busts out. In other words, they go broke. They lose, they buy more, they lose, they buy more, they lose, and finally they go, that's it, guys, I'm out. I have no more money in my wallet, and I can't hit the ATM anymore, so I'm gone. And so as the night progresses, these guys who aren't very good all fall away. And even maybe, you know, a guy that is fairly decent, he just catches bad cards, he can't win, he goes broke, he busts out. And so now, 4, 5, 6 hours into the game, the only guys you have left are the two very good players and two guys that are better than average. Now, if you're sitting in that game still at that point, you might as well get up and leave, because none of those guys are going to give away their money. They're not going to get involved unless they think they have an edge or unless they think they can beat you in a hand. The risk does not justify the reward, because even if you catch a hand, if the guy is good, he's going to know you have a hand and he's going to fold. So he's not going to give you any of his money. So there's no point in you risking whatever chips you have to try and get money from these other guys who are very good. At that point, it's pretty much all luck. So to compare, maybe around 8, 9, 10 a.m., a lot of guys are playing in the trading realm. They're all coming in. Maybe there was some news that came out, and everybody's making moves. But then as the day progresses, you have guys that may have been trapped, and they end up blowing out for a loss. The other guys were on the right side. They end up making their money. So guys who have been on the right side of a particular move, they get out, they take their money. If they don't see any more opportunity, they leave. Even large players, you know, same way. They maybe were able to defend the position, carry it through a level, make some money. They leave. So now, later on in the day, you have a lot fewer players, and now the only guys that are left are guys that have to sit there all day due to whatever kind of desk they sit on, and people who are losers trying to get their money back. Which would be the equivalent of here, you know, you're still sitting there with these 4 guys. Let's say you're player number 5, and you're still sitting there with these 4 guys that you know are really, really good, and yet you want to try and get your money back, so you keep playing, but you're playing against guys that you probably can't beat. They have more money than you, they play better than you, you know, so you're just going to be donating to these guys. There's no point in doing that. So, basically, what I've done is I've just made a little document here to kind of break this down for you in terms of writing it out. So, context, also what I would call living in the now. You always have to be living in the now, right here, right now, whenever you're making trades. So what I have here is There are no set parameters in trading. In other words, just because X happens doesn't mean that you do this or this. Sometimes whenever X happens, you may go short. Sometimes whenever X happens, you may go long. It just depends on the current situation right now and what's happening within the context. While any methodology is based on the idea that certain patterns repeat, the overall context of the action must always come into play. What is the most likely scenario based on what you are seeing right now? And then I have what I've labeled as 4 types of action. Now, these labels are for illustrative purposes. There's obviously no way to reduce and label every type of price action that may occur, but you will generally see some variation of the following descriptions. All right, so type number 1 would be what I call game on. Everybody's itching to play. Traders are firing, taking shots, attempting to defend positions, and attempting to create momentum. They're sitting tight when they're on the right side and puking out when they're on the wrong side. There's a steady flow of volume. We see this around news releases as well as pressure points such as breakouts or defensive plays around highs, lows, steps in the profile, or a price that seems to be holding strong. So, just for example, let's say it's 8:20 in the morning. It's not. You can see it's 11:50 a.m. here, but this will, make my point. It's 8:20 a.m. News release comes out at 8:30 a.m. When that news release comes out, there's going to be volume all, back and forth, back and forth, back and forth. I'm going to show examples of this as this video progresses. Everybody's in the game. Everybody's ready to go. That's when you want to be playing. Whenever, levels, someone's trying to defend a level, or they're trying to run a level. And you want to try to make the right call, of course, in that scenario. But at least there's going to be action. So there's a reason for you to risk your money because you're going to get paid if you're right. So the possible reward justifies the risk. So now your type 2 action is what I would call slow but methodical. Traders who swing large size are trying to position themselves for a move, but doing so in a very slow and methodical way. This action can look like it offers no opportunity, but in fact can yield very good trades if you have the patience to sit and wait. We usually see this later in the morning or afternoon after the initial reactions to news have settled. So again, the slow but methodical type action may happen actually around this time right here. It could, maybe 10:30, 11, 11:30 a.m. or maybe even going into the noon hour. What you might have is a situation where it appears like not much is happening, but there is a little bit of movement back and forth. The market may be ranging, like for example here on this day we see it was ranging pretty heavy between 2.5 and 3.5, 4. But there was some back and forth movement. There was some size being traded. You can even see it here. The market had pulled off of 5s here and was trading down a bit on fairly decent size. And so even though it's back and forth and in a range, there's still some volume moving around, and there may be a play to be had there. And so your job is to kind of try to identify, A, does this have potential for movement? B, if you think it does have potential, then what's the best entry price? Where would you be looking to go? And then C, of course, you have to manage the trade properly, meaning you already know that if you get into a trade in a slow but methodical type area, you're probably going to have to wait it out for a little while. It's not going to be like right after an unemployment report where you can hit it and instantly the market, may jump 5, 6, 6 in your favor, or may instantly be against you and you got to blow out. The slow but methodical phase requires you to sit through usually some back and forth action, and you have to allow yourself a small stop loss. I mean, you're not going to make a trade usually in this type of action where you're going to scratch the trade. You're going to have to step up, make the call, and then establish where you think you would definitely be wrong, and then sit in your trade and just ride it out. The third type would be what I call the suck you in or trap you type action. So this is the action that makes you think something's going to happen when in reality the odds are that nothing at all is going to happen, and you will either sit in a trade for an hour without the market moving or get hooked on the wrong side and blow out at the exact turning point which brings it back to your price. And I'm sure you've all been there. I've been there many times. Most of the major players as well as short-term scalpers have already made their moves. And the only people currently trading are large institutions who have to monitor the markets all day, and short-term traders who are down money and hoping to get their money back, right? You see this often in the afternoon. It might be 1:30, 2 p.m., 2:30 p.m., whatever. And the market's going back and forth, and you're just sitting there and you're trying to spot a move, but there's really nothing to be had. But yet it's moving just enough that you think, it might go. It might crack this level, even though in the back of your mind you're pretty sure there's really no reason for it to crack this level. And so the whole idea is large players can maneuver in those areas very, very well because the risk is highly limited. They know pretty much where the outside of the ranges are going to be during those time frames. So larger players can make some moves, and then they can even make it look like a level is going to break, and it gets through by one tick and then comes right back into the range. And so you try to go for the breakout play, you get sucked in, it rallies 3-4 ticks against you, you can't stand it, you blow out for a 4-tick loss, and that's the exact price where it stops, turns around, and comes back to the breaking point level. So you obviously want to try to avoid that type of action. And then the last type of action would be what I call game over, which is a total flat line, no action. No trade is better than a 50-50 shot, as opposed to some trades are much better than a 50-50 shot if you position yourself in the right price at the right time when the market's moving. So this is normally what you will see around holidays, rollover periods, and days when everyone is awaiting a major release such as unemployment, FOMC, etc. It also happens at some point every day when winners leave, losers throw up their hands and leave, and large institutions have nothing to do. So you may be sitting there and the market's in a 2-tick range and there's nothing to be had, and you can't even scalp a tick. It's not even to the situation where you can buy 2 halves, sell 3 is buy 2 halves. It just does not move. There's nothing to be done. The instant it goes up a tick and you try to go with it, it's going to come back down a tick, and then probably 2, and then you're going to blow out for a 2-tick loss, and then it's going to come back. It's one of those situations where nothing's going on, and you really have to identify that quickly and just stop even thinking about trading and turning off your computer and call it a day at that point, win or lose. And of course, all of this is based around the very simple idea of who's going to hit the next price. So you have to have that in the back of your mind at all times. If you buy or sell 2 halves or 10s or 18s, whatever the case may be, who's going to hit the next price? If you buy 2 halves, who has to buy 3s? If you sell 2 halves, who has to sell 2s? What's going on? What's the context? What's the overall action of the day telling you right now? And that's how you can make a better, educated, informed decision and make your your percentage of winners higher, percentage of losers lower, hopefully, and just make better trades all the way around. All right. So from here, we're going to progress on. I'm going to show you some real-world examples of how you can distinguish between those 4 types of action.